Hello investors, welcome back to the Mzansi channel. Today I want to talk a little bit further about dividends. So in the past weekend we had a webinar. We always have webinars where we talk about a lot of things with members of the mentorship program. So one of the questions that came in that webinar was who is entitled to receive a dividend? So that's a question that came from one of the members that was attending that webinar, right? So now before we answer that question of who is entitled to receive a dividend, first I would like to ask you that you subscribe to the YouTube channel if you haven't subscribed. But if you have subscribed, there's no need to press the subscribe button because you will just unsubscribe, right? So okay, there are different kinds of investors. There are retail investors and there are institutional investors. So retail investors, the simple definition is any individual that is investing in their own personal capacity. Most of us do DIY investing, so we open our stock brokerage account, maybe with its equities. Then we find the companies that we're interested investing in ourselves, and then we log into our account and then we buy those companies. So we are classified as retail investors as we are acting in our personal capacity. Then the other class of investors is called institutional investors. So those are like companies, maybe companies like Sanlam, who receive money from the investors, then they invest that amount that they get from investors. They invest it in different companies, right? So those companies like Sanlam, they act as asset managers, or they are called asset managers. So these asset managers, these are the ones that are called retail investors, right? It could be Sanlam, it could be Alexander Forbes, Allen Gray, what's this, Coronation Fund Managers. Plenty of companies are there in the space of institutional investors, right? So now, us, like I said, we are retail investors. We're acting in our personal capacity. Hopefully we understand what we are doing, because if you don't know what we are doing, we might as well take that money and give it to professionals there in the asset management space, and they invest on our behalf, right? So the second thing that you need to know is that there are different kinds of asset classes. So what do we mean by share classes, or different kinds of share classes? Shares are not created equal, right? We invest in ordinary shares, or they are called common stock, the ordinary shares. Then there are preference shares, right? This is how they differ. The ordinary shares are sold to anyone. Could be a retail investor, it could be an institutional investor, right? Those are ordinary shares, and those are the shares that you often buy as retail investors. Then there are preference shares, right? They get a certain preference. Some companies will do roadshows to market their business so that they attract investors. Then they promise those investors that, okay, the business has this prospect, it can generate this amount of cash per year, and this is how the investors could potentially be rewarded, right? So they're given a preference, and they're given a certain rate to say, okay, if you invest with us, you would get a dividend yield, maybe say of 5%. Find that some preference shares already have a predetermined dividend yield, right? So because they want to attract these investors, and sometimes there's a minimum investment amount you can make as a preference shareholder. Some companies, they might ask for 100,000 per share, or 1 million per share, or even 10 million per share. Yeah, but the number is irrelevant. What is relevant is that those preference shares, the agreement that the company that is raising capital and the potential investors, they have an idea of how much money to expect in form of a dividend yield, right? So as retail investors, most of the time buy ordinary shares, but sometimes like Capitec, you can buy preference shares from Capitec as a retail investor. And there are some other companies. If you are on Easy Equities, you will see the preference shares. They have that prefix PREF, like that pref. So if you want to buy preference shares, you can just buy preference shares. Then there's another catch. Now we're going back to the ordinary shares. Even the ordinary shares themselves, they are not created equal. Some ordinary shares have voting rights. The other ordinary shares don't have voting right. What do we mean by a voting right? You know, companies, they normally have annual general meeting, right? So whenever there's an annual general meeting, as a shareholder, you can vote on the company's resolutions. Let's say, for example, the company is considering to replace the current chairperson of the board or executive chairperson. So now they will ask the shareholders to vote. If you get access to the annual report, whether they send you the physical annual report or you download the annual report, there at the back it has a proxy form. You can fill your information there and then decide if you want to approve or disapprove the proposed executive chairperson of the board, or the executive chairman or chairperson of the board. It doesn't matter. Then you can fill in that proxy form. Remember, you're going to put in your names and your ID number. They have a database of all the shareholders, so they will know if your vote qualifies or if your vote does not qualify. So that is what we mean by a voting right. Right now we are speaking about ordinary shares. Some have voting rights, some do not have a voting right. Okay, then even there with ordinary shares, they still create a different class. The purpose of creating a different asset class is so that the founders of the company, or the people who owned the company before it was publicly listed, they can try to retain control of the now publicly listed company. For example, if you look at Alphabet, what you know as Google, it has two different kind of shares, maybe it's even three. But there's Google shares that are GOOG, and then there's Google shares that are GOOGL, right? One has voting right, one do not have a voting right. So those shares that don't have a voting right, they normally sell them at a discount compared to the ones that have voting rights. For example, the Alphabet shares that don't have a voting right, they sell under $500 US, but the one that have voting right, they sell over $2,000 US, right? So if you're not interested in voting but you still want to participate in the benefit of the business, you can just buy the ordinary shares that don't have voting rights. Okay, so now we know that there's different kinds of investors, retail and institutional investors. We know that shares differ. There's ordinary shares, there's preference shares, and any other kind of shares, right? Then of the ordinary shares, some ordinary shares have voting right and other ordinary shares don't have a voting right. Okay, normally as retail investors, we buy ordinary shares that have voting right. Unless you know what you are doing, you can choose to buy other kinds of asset classes, or share classes, whether they have voting right or they don't have voting right, as long as you know what it means, right? So now, the assumption is that you are a retail investor that is an ordinary shareholder. Then the company will declare a dividend when they either doing interim result or final result. Then they will tell you about the company performance, and then there is a dividend declaration. Remember, as shareholders, we are not entitled to the dividend. The board can resolve to use, the assumption is that the company is profitable. The board can resolve to take that profit and reinvest it in the business, either by improving the business, buying new plant, property, equipment, or using that profit to settle debt, and then they don't declare dividend, right? It doesn't matter how you feel about that decision. If the company is in debt and they're paying down debt, you can see that it's a way to add value to your shares, right? But some people, they prefer to receive their dividends because some people invest for income, right? So if the board declare a dividend that they're going to pay an ordinary dividend, because they can declare a preference share dividend. It happens. So if you are not a preference shareholder, you're not going to receive that dividend. But if you're an ordinary dividend shareholder, a dividend ordinary stock shareholder, and they declare an ordinary dividend, then you will be entitled to that dividend after they've declared it, right? So now the board has declared an ordinary dividend for ordinary shareholders. What else you need to know? In the previous video, we spoke about the date that you need to know, the last day to trade and the ex-dividend date. The last day to trade is the date whereby you need to own those shares to qualify to receive a dividend. After the last day to trade, the following day, it's called an ex-dividend date. So if you buy shares after that date, you're not going to receive those dividends, even though you are an ordinary shareholder. You see, so these are the things that you have to keep in mind when you invest in a company. You can invest as a retail investor, or you can take your money, give it to an asset manager who will invest on your behalf. They will be receiving the dividends, and then hopefully they will make a distributions back to you as an investor. But we are speaking from a context of you are a retail investor, you are in charge of your stock brokerage account, you decide which companies to buy, which companies to sell, and then you own ordinary shares. Then the board declares a dividend for ordinary shareholders, and you hold your shares up until the last day to trade. Well, if you're an investor, depending on what kind of an investor are you, you would be holding your shares, well, not forever. That's a bad strategy. But unless your plan is to hope in between companies that are paying dividend. But if you're interested in a company, let's say you're interested in Shoprite, you're just going to hold Shoprite and allow the last day to trade come, and then the stocks start trading ex-dividend. Because the trick there is that usually, not to say that it always happens, after the last day to trade, the share price can drop by the same amount of dividend that you are going to receive there. So some people, they worry about it. They want to get out before that happens. But if you consider yourself to be a long-term investor, it's not worth the effort. It's not something that you should worry yourself about. So that's it, what I wanted to touch today, to differentiate between retail and institutional investors, and also to differentiate between the kinds of shares that you can invest in, ordinary shares and preference shares. And then from there, to understand that some shares have voting rights and some shares do not have voting rights. And then once you are an ordinary shareholder, then when the company declares ordinary dividend, there are some dates that you need to keep in mind to make sure that you participate in that dividend. Because if you buy after the ex-dividend, you are not entitled to receive the dividend. So I hope that you found this video useful. If you did, please subscribe if you haven't subscribed to this channel. And also you can like, if you enjoyed this video, please give it a thumbs up. And just to make sure that you don't miss any of the videos that we'll be making in future, make sure that you click that bell notification so that you can be notified every time we upload a video. We will see you on the next video.